Inflation, you're thinking about it, your clients are thinking about it, but where's it headed? Where's the puck moving in terms of the markets for the rest of this year and beyond? Joined today by Phil Orlando from Federated Hermes to discuss. Hey Phil, welcome.
Thanks for having me.
So Phil, inflation, obviously a huge issue right now. What are some of your thoughts on what's going on with inflation?
Well, the market, I think, got it wrong. If you go back just a week ago, the month of May, stock market did really well. There was a perception that inflation had peaked in March, and that the Federal Reserve was going to be able to pause in September. Then we got the CPI report for the month of May, and that dispelled all of those illusions. We are looking at the worst inflation we've seen in 40 years, and the Federal Reserve is going to have to significantly ratchet up interest rates. We saw the first piece of that yesterday. A 75 basis point increase in the Fed funds rate by the Federal Reserve. First time they've done something of that magnitude in 28 years. So inflation is problematic. Interest rates are going higher. Quantitative tightening is coming, and as a result, the market is right-sizing itself to reflect all of those dynamics.
So as this belt tightens, what can investors expect? How are they going to react to this?
So bond yields higher, stock prices lower, and this is not unanticipated. We've been talking about a very challenging first 6 to 9 months of this year for exactly these reasons. Inflation is out of control. Federal Reserve policy was simply too loose. They should have been withdrawing accommodation, in my mind, a year ago at this time. All of these things were out there. They should have anticipated this. Fiscal policy has been too loose. So most of what we're dealing with is a result of policy errors out of Washington. And now we're going to pay the piper. We've got a right-sized policy in order to get the inflation dragon tamed, get the genie back in the bottle, if you will, and it's going to be painful.
And you guys saw this coming for quite some time, and so you probably have had things measured and ready, but some advisors have not been ready for this. What is the message now that they should be saying to their clients in order to kind of keep them on the straight and narrow, invested and ready, but it's still at the same time prepared for whatever may lay ahead?
Certainly. So the mantra here was to play defense in the first 6 to 9 months of the year. And that suggests having a little bit more cash than normal. Our cash allocation at Federated right now is a 3% overweight relative to neutral. That translates to a 6% allocation in cash. Now, that doesn't sound like much, but in the 20 years that I've been at Federated Hermes, that's the largest cash position we've ever had in a balanced equity portfolio. Second is stocks over bonds. Our bond portfolio managers literally like nothing. There is nothing overweight in the bond category. Everything is neutral or underweight. So we like stocks over bonds, and then within the stock allocation, we prefer value over growth, small cap over large cap, international over domestic. Those categories, from a valuation perspective, are about 40% cheaper than the areas that we don't like. Value, for example, you've got much lower betas, you've got much higher dividend yield support, and these stocks have held up much better. So you look at the stock market, which is down approximately 20% right now, growth stocks down 40%, value stocks down 10%. This is exactly the sort of thing we're talking about. We think that this environment is going to continue during the summer and probably into the late summer, early fall period. So it's a little too early to start getting offensive yet, but keep the defense on the field here, hunker down, try to preserve capital.
You've always had a good eye on the long term. Where's the puck heading from here?
So I think we're coming to an inflection point in that late summer, early fall period. So we've got a couple of things that we've talked about. Inflation is still rising, but if the Federal Reserve is going to be aggressively tightening policy now, correcting the mistakes they've made in terms of being too loose, that means we're likely to see a peak in inflation in the next couple of months. We think second quarter earnings are going to be very challenging. The year-ago comparison for the second quarter for the S&P 500, up 88%. It's going to be the toughest comparison in the cycle. And we already know companies are starting to talk about reduced revenues, slimming margins, earnings are going to be challenged. But as we get through the second quarter earnings season, which will be reported between mid-July and mid-August, the third quarter comparison's a little easier, and companies will start to manage to that. So as we get through the peak of inflation, the peak of Fed tightening, the peak of the earnings comparisons, then that puts us into the Labor Day period. And then investors will start to look forward to the midterm elections. What happens? The data that we're looking at right now suggests that there's going to be a pendulum swing to the right. And markets love divided government. So the combination of price earnings multiples falling from, say, 23 times earnings, where the market peaked last year, let's say prospectively to 15 times earnings, Labor Day-ish this year, you've got cheaper stocks, you've gotten most of the damage behind us, we're looking ahead to good midterm election results. That could be an opportunity where the market finds its sea legs, and then we start to post a nice fourth quarter rally.
So let's make it to Labor Day. We'll quote Green Day and say, let's wake me up when September comes. Thank you so much. Great conversation, Phil. I appreciate it.
It was my pleasure, Matt. Thank you so much for having me on.
Thank you. Hey, for Advisorpedia, I'm Matt Ackerman.